Welcome to the Ontario Mortgage and Real Estate Insights podcast, your go-to source for the latest developments, trends, and regulatory changes in the industry. I'm your host, Sandy, your guest host from Keller Williams Legacies, here to provide you with insights sourced from reputable news outlets to help you stay informed.
Steve Hamowin here. This is brought to you by Real Approved Inc., a trusted mortgage brokerage dedicated to helping Canadians achieve their homeownership dreams. Visit realapproved.ca to learn more about how our experienced team can assist you with your mortgage needs. Let's dive into today's episode.
Today, we're diving into a survey that's got a lot of Canadians talking. Conducted by Abacus Data in partnership with the Canadian Real Estate Association, this survey reveals that nearly 9 in 10 Canadians are worried about housing affordability and security in today's market.
Right, Sandy. It's quite telling that housing concerns are now on par with issues like the cost of living and healthcare. The survey, which gathered responses from 3,900 adults, shows that 87% of Canadians are anxious about the housing situation. This isn't just a single demographic issue. It spans across age, region, and political lines.
What's really striking to me is the report's assertion that housing is not just about affordability anymore. It's about security, control, and confidence in the systems that are supposed to sustain opportunity. That's a pretty powerful statement.
It is, and it highlights some significant cost pressures and generational divides. The rising cost of living is the top concern for 59% of respondents, but housing has climbed to 38%, surpassing even healthcare at 30%. Younger Canadians, particularly those aged 18 to 44, are feeling the brunt of this.
Yeah, Steve. And when you look at the prospects for home ownership among younger generations, it's quite disheartening. According to another survey by Easy Home Renovation, only 26% of Gen Z respondents feel confident they can afford a home in their desired area within the next 5 years. That's a huge gap in expectations and reality.
And Statistics Canada data backs this up, showing that households under 35 are the only group to have reduced their mortgage debt since 2022. Rising costs and interest rates are making homeownership feel out of reach for many.
Regional disparities are also at play here. Concerns are highest in Quebec, Atlantic Canada, and British Columbia, with percentages ranging from 42 to 45%. It seems like this is hitting all corners of the country.
Absolutely. And the generational divide in optimism is also stark. Only 4 in 10 Canadians believe homeownership is still a viable dream, and that drops even further among those aged 30 to 59. It's almost like a breaking point for the social contract that promised stability through effort.
RBC Economics does report some improvement in housing affordability over the past 6 quarters, but Robert Hogue warns that these gains might slow down as income growth cools and the effects of rate cuts fade. It's a mixed bag of news, really.
Financial insecurity is a persistent theme here. Just over half of the respondents are worried about keeping up with mortgage or rent payments, with young Canadians, lower-income households, and families with young children feeling this pressure the most. And 55% fear losing their home if their finances change suddenly.
Despite these challenges, the aspiration to own a home remains strong. 65% of non-homeowners still want to buy eventually, and that number jumps to 86% among 18 to 29-year-olds. But barriers like a lack of affordable supply, high construction costs, and rapid population growth are significant hurdles.
As the Carney government prepares its first federal budget, there's a lot of pressure to deliver tangible relief. Canadians are not just looking for promises, they want real progress that restores confidence in the path to homeownership and housing security.
Next up, we're turning our attention to something that many Canadian homeowners are facing: a potential shock when it comes to mortgage renewals. Christopher Liu has highlighted that mortgage rates have been climbing sharply from historic lows, which could mean significantly higher monthly payments for many borrowers.
That's right, Sandy. According to Liu, those renewing their mortgages between 2025 and 2026 could see payment increases ranging from 15 to 20%. And for a particularly unlucky 10% of homeowners, the increase could be as much as 40%.
It's pretty alarming. especially when you consider that some people might get priced out of their own homes. Liu points out that 5-year fixed conventional mortgage rates were in the 4 to 6% range in the early 2020s. But by 2023 to 2024, they spiked to as high as 8% before settling back to around 6%.
And while rates might have cooled slightly, many homeowners renewing this year will still face higher payments compared to what they were used to. The central bank's policy rate has driven these shifts, pushing lenders to raise their offers. For those who locked in at a low rate a few years ago, it now seems like a generous deal.
The Canadian Mortgage and Housing Corporation reported that the average mortgage payment in the first quarter of 2025 was $2,086. Depending on renewal, this could jump to $2,399 for a 15% increase, $2,503 for a 20% increase, and a staggering $2,920 for a 40% increase.
With many Canadians living paycheck to paycheck, even a 15% increase could be unaffordable for some. Liu suggests that homeowners may need to sell and downsize, or even re-enter the rental market if they cannot handle the increase.
It's crucial to prepare for these changes. Liu advises homeowners to start by calculating potential payment increases using online calculators to know their shock number early. It's all about adjusting budgets and making informed decisions.
And when it comes time to renew, do not just accept the first offer from your lender. Comparing rates from different banks, credit unions, and mortgage brokers can help you secure a better deal. Lenders are competing for renewals, so use that leverage.
If higher payments are unavoidable, consider extending your amortization period to reduce monthly payments, though it may increase your total interest over time. Building a financial cushion with extra income can also ease the transition.
And remember, if rates drop before your renewal, refinancing early might lock in a lower rate. But be sure to weigh any prepayment penalties against the potential savings. Consulting a mortgage broker or financial advisor can help with these calculations.
Ultimately, if the payment hike is too much to bear, selling and downsizing or renting out a room could be options to consider. It's about adapting to these financial challenges with a proactive approach. Let's talk about some interesting developments in Ontario's credit union sector. According to a recent report by the Financial Services Regulatory Authority of Ontario, credit unions have seen a notable growth in assets during the first quarter of 2025. This growth is primarily driven by increased demand for mortgages and commercial loans.
That's right, Sandy. The report highlights a $3.26 billion increase in total sector assets, which is a 3.26% jump compared to the same period last year. It's quite significant, especially when you consider the current instability in the housing market. Property values have been dropping in the Greater Toronto Area, and yet, residential mortgage loans within credit unions grew by $1.11 billion, or 2.06% year over year.
It's interesting that despite a downturn in the market, borrowing costs and home prices have declined over the past year, making monthly payments more manageable. This has encouraged more households to consider home buying.
Indeed, Sandy. Recent interest rate cuts from the Bank of Canada seem to have played a role here, enticing some Ontarians to enter the housing market. Economist Christian Bravo pointed out that as housing prices come down, people who have been waiting on the sidelines are now jumping in. However, it's not necessarily in the high-priced downtown condos of Toronto.
Right, Steve. According to a report from Altus Group, home sales in the province have hit record lows, yet completion rates are at record highs, leading to the highest housing inventory levels to date. The condo market in Toronto is indeed suffering, but as prices drop, demand increases.
And it's not just the residential side that's seeing growth. The demand for commercial loans has also boosted credit union assets by $1.94 billion, or 7.68%, in the first quarter of 2025. This is despite a decrease in cash and investments by $292.23 million, or 2.57%.
It's fascinating how the commercial side is picking up. Bravo mentioned that commercial loans are often used by businesses for new investments or working capital. He speculated that after a decrease in lending due to uncertainty from United States tariffs, businesses are now investing again as they gain more clarity.
That's a good point, Sandy. While credit unions are relatively small in the overall financial system, the trends we're seeing in commercial lending are similar to those in larger banks. Bravo noted that tariffs are affecting specific areas, but most exports remain unaffected. However, where they do impact, commercial lending might face challenges.
Overall, it seems like there's a cautious optimism in the market. Both the residential and commercial sectors are showing signs of life, despite broader economic challenges. It's about adapting to the changes and finding opportunities where they exist.
Absolutely, Sandy. It's a dynamic environment, and as we've seen, credit unions are capitalizing on the current conditions. It'll be interesting to see how these trends evolve in the coming months, especially with the ongoing economic shifts.
Now, let's shift gears and delve into the latest expectations from the Royal Bank of Canada regarding the Bank of Canada's rate decisions. According to Claire Fan, a senior economist at Royal Bank of Canada, the Bank of Canada is projected to cut rates by another 25 basis points in October. This follows their September decision to restart the easing cycle after a 6-month hiatus.
That's an interesting development, Sandy. Claire Fan mentioned that the central bank's decision was motivated by several factors, including a softening labor market, sluggish gross domestic product growth, and a slowdown in core inflation. These are significant indicators that the economy is cooling.
Absolutely, Steve. Fan pointed out that the September rate cut was driven by rising unemployment and a deceleration in population growth. Without a significant uptick in labor or inflation data, RBC expects another 25 basis points cut in October. It's a cautious approach to stimulate the economy.
However, not everyone agrees with this prediction. Derek Holt from Scotiabank suggested that a rate hold could be more probable, especially given the strong September jobs report. The labor market added 60,400 jobs, and the jobless rate remained steady at 7.1%. It's a complex situation with mixed signals.
That's true. Holt mentioned that the central bank's decision on October 29 is still open, and upcoming data like the Consumer Price Index and the Bank of Canada's quarterly surveys could influence their decision. It's a dynamic environment with many moving parts.
And Holt also raised concerns about the reliability of the latest jobs data. He noted that if last year's seasonal adjustment factor had been used, job gains would have been closer to 20,000, which is just a third of the reported figure. It's important to consider these nuances when interpreting economic data.
Beyond domestic factors, broader economic challenges are affecting the Bank of Canada's outlook. United States Section 232 tariffs on Canadian exports, like softwood lumber and kitchen cabinets, are set to take effect on October 14th. Although most exports remain protected under CUSMA, these targeted industries could feel some pressure.
Preserving Canada's CUSMA tariff exemption is crucial for the near-term economic outlook. Despite these headwinds, RBC expects the Canadian economy to return to modest growth in the third quarter, with an annualized GDP increase of 0.5%. It's a balancing act between managing challenges and fostering growth.
And with the federal budget update in November, there could be larger deficits, which might provide some offsetting support through increased government spending. It's a situation where fiscal policy could complement monetary policy efforts to stabilize the economy.
Indeed, Sandy. It's a complex landscape for policymakers, and these rate decisions are just one piece of the puzzle. It'll be interesting to see how this plays out and what it means for the housing and mortgage markets. Thanks for tuning in to another episode of the Ontario Mortgage and Real Estate Insights podcast. We hope you found today's insights valuable as you navigate the world of mortgages and real estate.
Before you go, a quick reminder, Real Approved is here to make your mortgage journey smoother. Whether you're buying your first home or refinancing, their experienced team is ready to guide you with personalized support every step of the way. Visit realapproved.ca to get started and take the next step toward achieving your homeownership goals. Catch you next time and stay informed with the latest industry insights.